Welcome to Real Estate 360 with real estate expert and my friend, Kenn Renner, joining us. And we got a lot to talk about today. Things are moving quickly, happening fast, and at the same time, people got to be patient.
Oh, exactly. Yeah. Sandy, we've been doing this, what's over now 3 years.
I know.
Yeah. Wow. I would think it was about this time 3 years ago. We started just around pandemic time, or it was before.
Just prior.
Yeah.
Prior to the pandemic. So I'm getting a lot of good information out there. Yeah. I know a lot of people look forward to listening and watching and finding out what's going on in the Central Texas real estate market. You're the guy for that.
Well, I appreciate that. Yeah, I'm really excited about this one because we're talking today about how the tax laws have changed and that we've had tax reform recently. I also want to talk about a little bit about the stats and also actually we got the honor to see Grant Cardone, Elena Cardone. They flew into the Austin Board of Realtors, had a presentation at Austin Board of Realtors last week and had some really good insight there. We'll do a separate podcast on that.
How was attendance for that?
It was packed. There was probably 300 realtors in the room, and it was so it was good. He asked some questions that was pretty interesting. One, he said, how many in here are realtors? Well, they're all realtors, so everybody's hand. And he said, how many of you own your own home? About a half, maybe three quarters. And they said, how many own investment property? I'd say probably about 20%. But then the one that really got me was how many in the room were here during the 2008-2009 financial crisis. My daughter was with me, and she's like going, there were like 5 hands that rose.
Yeah.
So, that's something that's to be said for is those that hadn't gone through the financial crisis don't really know how to sometimes navigate these tougher waters. And 2023 was a tougher year in real estate. And so, but Austin did really pretty well. We're going to see those stats here, all in all, and it wasn't a real big crash. He actually said that there is no possibility of a correction in the single family market. Absolutely none.
It is what it is.
No way, because it's just simple economics. We're still 4 million short. 4 million housing units short. They stopped building in 2008 all the way to 2012. So we're 4 million short, and to catch up, it's not going to happen. So it's going to take years to be able to catch up, and the builders are doing what they can to catch up. But that's the bottom line. We have not enough housing. Now, he did say that the apartment and the commercial market, that's where things are going to get real dicey coming up, because a lot of these big loans, institutional loans, are coming due. The fixer flippers that were doing these apartment syndications, they've got debt now that they were expecting to be at 3-4%. Now it's at 7.5-8%. Yeah, so there's going to be opportunities is going to be in multifamily. But he said consistently, single families, you're not going to see a crash. So it's a safe place to park your money. Also, he did mention some areas and I'll say that in the next podcast, of where your investment in Texas. It was Austin's not ready because it hasn't had a correction. That's in the commercial stuff, and it's definitely going to have a correction. But then it was for just regular single families for cash flow, because that's what he was talking about, cash flow, is San Antonio, and then the areas in between San Antonio. You mentioned those specifically. And of course, we've been working that market for a year,
right?
Or more than a year.
You kind of were ahead on that. You knew that last year, 18 months ago.
Well,
you were saying
it's all about the numbers. It's a lot of these homes that we're purchasing are 50% of the median price that they are in Austin, and they're only 50 miles away or 50 minutes away. So yeah, it's been good, and it's still going good. But what's made that even more attractive is that the tax rates are plummeting, and we'll go into that in a second.
Okay.
But let's get into stats here. I had a year-end stat, December 2023. You look at that number, is 443 is the median price and it was only down 1% from the previous December. So we're talking about it's been pretty flat as far as there wasn't, of course, all of our stats, and I told that was going to happen. It was going to start to get back to where where it was pretty much the way it was last year, and appreciation will start again. And that's what we're seeing right now, as we're seeing a huge, when we're out there with the last couple of weekends looking at investments and first-time homebuyers, we're out and we're seeing that these builders models have got people lining up one after the other. They're selling 20, 30, sometimes 40 houses in a month or two.
Wow.
Yeah, it's back to that. And so inventory is getting bought up, and I try to tell people is that what you see here inventory-wise will probably be gone by next week.
Yeah.
So yeah, it's really, really picked up. It happened last year, but I think it's even happened bigger this year. The last half of 2023 was really slow in the real estate market, all the way around. We did well, but it was like it seemed like everything stopped. People weren't buying, and that happened the previous year. Of course, the rates didn't help, being they peaked at like 7.5% in October.
Are you just seeing people right now that are just a little more serious than they were before? Like they're leaning in a little more.
It's pent up demand.
Yeah.
I think, and there was a stat that said 50% of people who bought in the pandemic really didn't buy a house that they really wanted. And then we've got the whole next generation coming up. The millennials are hitting the market, and that's who I'm working with right now, and even Gen Zers. And so it's definitely people want the stability of a home. They don't want to be renting forever. But then again, they're the apartments are going to be struggling and suffering, and so that's why people want to get out of them. A guy we just sold a house to is living on 11th Street. He goes, it was nice to be there, but it was way too congested. It was just too loud. It was just not. It wasn't fun. You couldn't.
Yeah, people buy homes and they're like, I'm going to die in this home, and then they think a few years go by and they're like, I need to, You know what I'm saying? People think they're going to stay there forever, but they're not.
Well, I try to tell my first timers, especially, that you try to buy your second home first. In other words, we started looking originally at 1,200 square foot houses. I'm like saying, three bedroom, 2 bath, 1,200 square foot. You're going to be calling me in less than 2 years saying this house is too small. Yeah. So I say, let's get, now we're looking at 2,600 square foot, and with the builders, they're also cranking also because they have the builder incentive finance money.
Right.
And there's just it's very hard for resellers to resell homes to compete against that. But yeah, so looking at the stats, we have 3 months of inventory, which is even still half of what a normal equal seller buyer inventory would be. So usually that's 6 months. So we're still low on the months of inventory, but we're also seeing the average days of the market kind of creep up. There we're at 84 days on the market. So if you're thinking about selling your home, then you're looking at probably 3 months is on the average. So prepare for that.
Boy, gone. That's a lot. I mean, it wasn't that long ago when the numbers were.
Was it 2.5 years ago? It was actually, our sheet showed 0.
Right.
There was 0 days on the market.
Now 84. It's probably a normal number, but it seems like a big number comparatively.
Compared to 2019,
right.
it was about 60 days. It's kind of like that. So I'm just glad to see that the market's stabilizing. We have 7,700 homes on that are active listings, which is down from over 10,000 we had a few months ago. Still not enough. Still have. We still have a shortage, really. Mm-hmm. But one thing that was really surprising as I was starting to do my performance for some of our investments is I was really starting to look at these tax rates. So we're going to talk about today. There's been tax reform, but there's also been tax rate drop. And so we'll talk about that. In November, they passed Prop 4, which is was $18 billion in property tax cuts. That really, one of the big ones is for our homesteaders, those that own their own home. The exemption for school taxes went from $40,000 to $100,000. Mm-hmm. So that's going to probably average out to about maybe $100, $120 a month, every month less, just from the exemption alone. So that was a good. So it doesn't really help our investors because it's tied to being a homestead. They did put a cap for investors, but this is kind of a moot point cap, which is 20%. In other words, in homestead, if the property value goes up 10% or more than 10%, they can only raise your taxes at 10%. Investors, there was no cap. If the property value doubled in a year, the taxes could double. So now we're looking at a 20% cap on that each year, at least for the next 3 years. I don't think we're going to see any 20% appreciation coming up in those homes right now. But there's also some things, a little bit of housekeeping for those that did buy houses last year, especially if they're my clients and being and it was a homestead. Make sure you file your homestead exemption. It's something that can be done online. Homestead exemption gives you that 10% cap, amongst other things. It gives you that $100,000 break in the value of the school taxes. So I started looking at the homestead exemptions to remind part of our podcast of what these are. The general homestead exemption, anybody can apply for it. It's a homeowner, and you want to do that in the year right after the year that you purchase the house. There's the over 65 exemption. which I know I'm getting closer to it than you are, Sandy. But that'll freeze our property taxes. And believe it or not, it can be transferable from property to property. It just depends on where you're moving to. Another one good for our veterans is especially our disabled vets. 100% disabled vets get no property taxes, 0. And so I remember selling a house up in Belton to a young lady. She came into one of our first-time home buying seminars, and she said, I really want to buy a house, but I can't afford the payment. I go, well, let me ask some questions. And we found out she was a disabled vet. We're looking at a beautiful $225,000 house at the time. Was going to get her 2,400 square foot, in the area. And she was like going, I can't afford that. And I ran the payments. I go, yeah, it's up there. And I go, oh, you're a disabled vet? Your payment's $750 a month.
Yeah.
And she went from not
she
knowing.
Earned it.
Yeah.
She earned it.
Yeah. She went not knowing
right.
to now living in a house for $750 a month. That's a 2,400 square foot house. So,
nice.
Yeah. Then there's also partial exemptions for vets as well. And then also, I didn't know this, those that have paid the ultimate sacrifice, their spouses get to keep the 100% exemption. And even first responders that died in the line of duty, their spouses get the 100% exemption as well. Just kind of a little food for thought for those that serve us so well. But here's the thing that I noticed, and it was very eye-opening, was the tax rates have dropped dramatically. And I want to talk to my former clients as well, or anybody who wants to look up their tax rates. Sometimes can be a little bit ambiguous of where you find that. It's in the county appraisal district, but then you got to find it and add it all up. But if you call me, I can pinpoint it and we can get you that new tax rate. So just on my own properties alone, like the house that I live in right now in Santa Rita Ranch, I bought it in 2020, and the time the tax rate was 2.7%. Right now, I double checked on that; it's 2.1%. So on $1 million house, that's a six tenths of a percent, 6/10 of a point. That's $6,000 less that I'm having to pay. On our investors, same thing. We're seeing tax rates, especially like in the New Braunfels, San Marcos area, that they're approaching 1.2 and 1.3%. And, we're selling those same houses a year ago, 2 years ago at 2.3 or 2.5. And so a 1% drop in a $300,000 house is $3,000 a year, which translates to $280 a month in savings just in taxes alone.
Yeah. So
that now has changed the picture of our properties, where we get a nice, solid, positive cash flow simply because of the tax rate. The reason they did that was there's two functions to the tax, how they calculate the tax. First is the appraisal, the assessment that this county does, which happens basically by middle of April, we're going to have our tax appraisals come out. It's based on the value of the property as of January 1. So January 1 is what they're looking at. And to me, it looks like we had basically a flat year. So, but the taxes rates are set sometime in the fall, and they come out towards the end of the year. And so we really don't know what they are until they're posted. And that was really exciting. I mean, like the house in Avery Ranch that I had, that used to be Avery Ranch is 2.8%, 2.7 when we first started buying in there, 1.96. That's a substantial drop.
Sure.
And it's the problem that we have, though, and I'm looking into this, and I'll talk to you on a podcast, is that the payments haven't dropped. Their escrow account has not dropped because it's based on last year's, and we have to wait for the mortgage company to get around to doing a escrow analysis. So I'm looking at saying, hey, let's wait. Why we wait for them to get around to when they want to do their escrow analysis? Why don't we have them do it now, knowing we have lower tax rate and lower tax values or flat tax values? We should be able to get those. I think a lot of people are going to get refunds, and that's good news. So check your tax rate. It's pleasantly surprised with what's gone on with that. And it also can show you how it affects our investment properties. So here we got a typical pro forma. I know it's hard to read on the screen, but that's because I'm going to break it down by section here. And this is a pro forma that I put out to our clients when they're thinking about investing in a particular neighborhood properties. That's very specific to a particular size, the exact home that they're buying. But if you take a look here at the upper left-hand corner, then with the property assumptions, basically looking at New Braunfels house, this is as of this home's available right now, $243,000, and it's assessed right now. It's appraised now. A tax rate is 1.36. Yeah. So that changes everything. And with this is a 1,440 square foot house, 3-bedroom, 2-bath. And the thing about this is it's 243, but just a month ago we were selling the same house for 225, or almost 20,000 less. And so those that bought with me 2 months ago with the same house, they've had an instant $20,000 appreciation.
Right.
So, but the numbers still work at 243. So it's, especially with the lower tax rate, and the rents in this area are pretty good, to $1,795, $1,750 for that house. So looking at these you got the circled one, this is a 1.36 tax rate, but also you see purchase closing costs. We're going to get into the second, only $2,000. And that's because the builder pays a majority of the closing costs. So, normally closing costs on a house like that would be $7,000, $8,000, maybe $10,000 after you get in with prepaids and everything. But the builder pays a substantial portion of that. So looking at after doing analysis for what we call a cap rate, which is where you kind of compare investment properties to investment properties, is basically taking net operating income and dividing it by the price, and that gets you a capitalization rate. And usually considered five cap is and above is pretty good for an investment. And at this point, with what we have is 5.43 cap rate, but cap rates are can be kind of like an eyeball, kind of winging it, because new construction doesn't have nearly as much capital expenditures you have to put into a property. I mean, everything's under warranty, everything's brand new. Where older properties, they have repairs and maintenance and things that are more expensive. So, but those are not figured into cap rates. So capital expenditures, like I had a house in Temple that I just sold. I only paid $75,000 for it, great little house. It went up to 140 over a couple of years. So I'm like, okay, time to sell. But the problem was it was throwing off some good cash flows, about maybe $800 a month, but the problem was the sewer line was built in 1950, so we had to replace the whole entire sewer line at the cost of $19,000. Yeah, and so all my positive cash flow for 2 years got wiped out by that one capital expenditure. So that's another reason why we like the new stuff. So cap rates are good, but they're not all the story, right? So looking at a typical 25% down purchase, I really encourage put 30% down. It's a nice, comfortable level, but 25% still works. For those that are trying to build portfolios quicker, they can put 20% down if they want and have less cash flow, but have more cash to be able to put in the next property, because we have a lot of people who are building large portfolios of properties. And this is a buy and hold strategy. It's worked. It's tried and true. You have to be patient, and it's not a get rich quick. It's not get rich quick. It's get rich consistently, right? So, and I own over a dozen properties. My family all owns properties. My employees and people who work for me have properties. So we're all like this big real estate family. We buy the stock that we're selling.
Right. Right.
So yeah, and the big thing here with our builder with the national forward commitment money is we're looking at 5.25%, 5.5% financing. That plays into the numbers. And then you're also looking at a positive cash flow of 237. Grant Cardone said it from stage. Grant's a billionaire, owns over 12,400 apartment units across the nation, and said cash flow, not cash is not king, because cash goes down in value, but cash flow is king. So, and it's not that you're going to get rich on $200 a month, but the bottom line is that you can hold on to it forever as long as it's not, you're not having to feed it.
Right.
And so I know we have a lot of clients that are break even is okay, because they've got portfolios that have cash flowing property, and they have ones that are just for appreciation, kind of like stocks and bonds,
right?
Buying them for different reasons. And so I see a lot of times we will take somebody and have them buy an investment that's going to throw off a couple $100 positive. And then if they have a break even up here, that'll help offset that. So, Austin's really, we're back out looking at investments because we see the curve. We see these values are going up. And you're pretty much with 25 or 30% down, you're lucky to break even with the lower tax rates that we're seeing in Austin. But it is it's true, and it's reality that we're starting to see that big jump in values, and that's why we buy real estate. We don't wait to buy real estate. We buy real estate and wait. So last year's we have in one of my charts at the bottom of my performance is a return on invested equity. And this is kind of a chart that pretty much figures what the initial cost to get into the property was, and then takes into consideration a 5% appreciation rate, which is very conservative. It's typical of what it's been over the last 50 years in the United States. 5% appreciation rate. And then it also takes into account the equity, the loan buy down, as it amortizes.
Right.
So it doesn't count any positive cash flow if there is any, not on this chart. But this is really eye-opening because you start at this 25% down on this property, $62,000 down with closing costs, everything in. And so within 3 years, just by a 5% appreciation rate and a little bit of the equity, a little bit of the loan buy down, it's an 86% return on the initial cash that you put into it. Okay. But remember, the person that bought the house from me 2 months ago also got a $20,000 bump in value. Mm-hmm. So they got an immediate 30% return by buying it in the return on their equity plus. So their total after 3 years, if it just appreciated at 5% with the bump that they got when they bought it, you're looking at maybe 130% return. Now, where else can you get that? And guess what? You're not having to pay, the tenants are paying off your mortgage. No,
Right.
So you get the tax benefits, you get the buy down, all the reasons we talk about in the podcast about why we're doing this. So it is a great time to be jumping into the investment market. Prices are going up. Interest rates are a challenge especially for those that don't have the builders financing money. So that's why the builders are cranking, and I'd love to help work with people to whether they're new, first-time home buyers, move up, and or investors. We do like the new construction. It has a lot to do with that financing. So, Sandy, another great show to.
Yeah.
Do you have anything going on?
That's a lot of information.
Yeah.
That's good, though. It's good stuff. It's good seeing you.
Yeah, I appreciate you. We'll see you. And I'll get back into what Grant and Elena had to say after they flew back out of on their jet back home to Florida, Miami, Florida, and we'll get those stats out for you too. So,
All right.
Thanks a lot. Talk to you soon.